Hello class, this is Dr. Fenton. In Chapter 3, we are going to continue the discussion started in Chapter 2 concerning job order costing. In this chapter, we are going to focus on cost flows and external reporting. So let's get started. First of all, we have some vocabulary terms, and some of these are review and some of them might be new. First of all, job order costing, which of course we started in the last chapter, and this is a costing system used in situations where many different products, jobs, or services are produced each period. Absorption costing, which is what we've been using, even though we maybe have not used this term yet, it is a costing method that includes all manufacturing cost, direct materials, direct labor, and both variable and fixed manufacturing overhead. And that's all goes in the cost of a product. Now, absorption costing is opposed to variable costing, where variable costing just includes variable cost in the product. But we've been using absorption costing, and most companies, well, they have to use absorption costing when they report the numbers outside the company. Allocation base, we talked about this in the last chapter. This is the measure of activity, such as direct labor hours or machine hours, that is used to assign cost to cost objects. In Chapter 2, we had an example where we used direct labor hours to attach overhead cost to the cost job. Predetermined overhead rates, again, we talked about this in the last chapter. You can see the formula at the bottom. The predetermined overhead rate is found by dividing the estimated total manufacturing overhead cost, and this is for the year coming up. Divide that by the estimated total amount of the allocation base. For example, total estimated direct labor hours for the year that's coming up. Overhead application, we did this in the last chapter. This is where we finally attach to particular jobs a certain amount related to manufacturing overhead. For each job, we know the actual direct materials they use, we know the actual direct labor cost, and then we use this overhead application, again using the predetermined overhead rate, to attach some overhead cost to the jobs being produced. Normal costing, this is what we've been using, a cost system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base incurred by the job. Nothing new here, just a new term. We saw the job cost sheet in Chapter 2's PowerPoint slides. More definitions. These even go back to Chapter 1. Raw materials, they include any materials that go into the final product. So any of the production costs related to materials. Work in process, this consists of units of production that are only partially complete and will require further work before they are ready for sale to customers. So the work in process, and this is an inventory account, so the work in process inventory account is where we accumulate cost, materials, labor, and overhead while the products are being worked on. Finished goods, this consists of the completed units of a product. So once you complete a job, you transfer the total cost for that job out of the work in process inventory account into the finished goods inventory account. So yes, the finished goods account is an inventory account. Cost of goods manufactured, this is just the total of the manufacturing cost associated with the goods that were finished during this period, with the jobs finished this period. So this picks up all the materials, all the labor, and all the overhead for the jobs that were completed this period. I like this slide because it shows you in sort of a picture format how the costs flow from one account to the other. We can see that raw materials, they go into, when you purchase those, they go into a raw materials inventory account. They will stay in this balance sheet account until they are issued into production. And then we issue into production, the direct materials will go into the work in process account. Direct labor goes into work in process. Manufacturing overhead, when we apply it, goes into work in process. And then once we accumulate the cost and finish the units here, when they're finished, we transfer the cost out of work in process inventory into the finished goods inventory account. They will stay on this inventory account until they're sold, and then when they are sold, we transfer the cost from this finished goods inventory account into the cost of goods sold account. So a nice review of the cost flow for production cost. Raw materials come in, The part that's direct materials will be issued to the work in process account. Direct labor comes in, manufacturing overhead comes in, accumulate the cost while they're being worked on. When you're finished, transfer all the cost into finished goods inventory. When they're sold, they go in the cost of goods sold account. Any period cost, selling administrative, what I call the front office cost, those are expensed immediately straight to the income statement. Here are some T accounts, sort of showing the same thing. A little bit more detail about raw materials. You purchase raw materials and you will debit raw materials, this account, while you credit, accounts payable or cash. Now, raw materials really are broken down into two different categories. The direct materials, as we saw in the previous slide, go straight into the work in process account. Indirect materials are classified over here, debited into the manufacturing overhead account. So the manufacturing overhead account, and this is not an inventory account. This is just a temporary account used during the year. It's used on the debit side to accumulate your actual overhead cost. And one of those will be indirect materials. So your raw materials, again, the part that's direct, the main product cost, like if the product uses a lot of metal, a lot of wood or whatever, those are direct materials. They are transferred straight into the work in process account. So you will debit work in process inventory. You will credit raw materials inventory. Indirect materials, the smaller items like glue or small nuts and bolts and so forth, those are transferred into the manufacturing overhead account. So you will debit manufacturing overhead while you credit raw materials inventory. Here's the entry. When you buy materials, debit raw materials, credit accounts payable, or if you're paying cash, you can credit cash. Here's the issuance of the raw materials into the direct materials part, work in process, indirect materials part into manufacturing overhead. Now all these entries we're going through here, they're in your chapter. So there's a lot more reading you can do about this in chapter 3. Labor cost. As you pay wages, you're going to credit salaries and wages payable, and we have two possible debits. The direct labor, the salaries and the wages being paid to the people on the production line, you're going to debit work in process inventory and credit salaries and wages payable. For the indirect material, and this will be for the supervisor salaries, the manager salaries, the facilities staff salaries, that's indirect. They're not on the production line putting the product together, but they are supporting the production. So we're going to debit manufacturing overhead, again to accumulate the actual overhead cost, and credit salaries and wages payable. Here's the entry. Debit work in process for direct materials, let's say $60,000. This is the example in your book. And then let's debit manufacturing overhead, $15,000 for indirect labor, and credit salaries and wages payable for the total. What we're going to do here, go back up, sorry about that, is many different other overhead costs will be included as debits into the manufacturing overhead account. Remember I said a minute ago, manufacturing overhead is not an inventory account. It is a temporary account used to accumulate the actual overhead cost on the debit side. And we're going to see in a few minutes, when we finally apply overhead, we're going to put credits over here as we debit work in process. But now we are concentrating on the actual overhead cost going in here as debits. We've already placed into here the indirect materials and indirect labor. And now any other cost you might have that would go in here. For example, this could be like utilities, rent, other miscellaneous factory overhead costs. This is sort of a simplified entry for this. They're taking all these, adding them together, and showing you that you would debit manufacturing overhead and credit accounts payable, or if you paid this in cash, you would credit cash at the same time. So your actual overhead costs are debited to the manufacturing overhead account. Here's what I mentioned a second ago. Now as we apply overhead, as we use the predetermined overhead rate, we'll take that times the allocation base, like direct labor hours or whatever. Then once you get that total number, we're going to debit work in process inventory as we credit manufacturing overhead. So again, the overhead account, the debit side accumulates the actual overhead cost. The credit side shows how much we've applied to overhead based on estimates, right? Based on estimates. What we're showing here is that as we apply overhead, like I just mentioned, in this case, the example that was in your book, $6 per machine hour was the predetermined overhead rate times 15,000 machine hours. They're using machine hours in this example, not direct labor hours. Multiply these two to get $90,000. So once you get the total amount of applied overhead that needs to be applied to this job that's in production, you debit work in process for the $90,000 and credit manufacturing overhead for the $90,000. For non-manufacturing cost, they are expensed in the period incurred. For example, salary costs, marketing, selling, administrative costs, they're all expensed in the period incurred. Here are a couple of examples. You could debit salaries expense while you credit salaries and wages payable. This is for, again, what I call the front office salaries, front office cost. These are not related to production. If they were, they'd be going into the manufacturing overhead account as a debit. But these are not manufacturing related cost. So debit salaries expense. This one, depreciation on the front office equipment, debit depreciation expense, and credit accumulated depreciation. More advertising, other selling administrative cost, you would debit those accounts. Those are expense accounts going straight to the income statement. And you would credit accounts payable or cash or whatever is appropriate. Once you finish production, for like a job you finished, they're fully complete now. You've attached all the materials, all the labor, all the overhead to that job. They are complete, they're finished. We transfer that total cost for that job into the finished goods account. This is another inventory account. So we're going to debit finished goods inventory and credit cost of goods, credit work in process for the cost of goods manufactured. This is the total cost of the goods we have completed. Here's an entry, debit finished goods, and you can add inventory out here if you want to. It is an inventory account. And credit work in process inventory. And the example in your book, $158,000, so that's the debit and the credit. Again, this is the entry that you make when your goods are completed. You move them out of production into the finished goods warehouse, storehouse, and then you debit finished goods inventory and credit work in process inventory. On this one, if you had a job that was not completed, and by the end of the month or end of the year, whatever your ending period is, the cost you've assigned to that job, the job that's not completed, so we're talking the direct materials cost, the direct labor cost, and the overhead cost attached to this job that is not complete, those costs stay in work in process. And they'll carry over to the next period. And once you finish this job in the next period, then you'll transfer all the cost out of work in process into finished goods inventory. But again, any costs that are not complete as of the end of the period, any jobs not complete, the cost related to those jobs stay in the work in process inventory account. Once you sell the product, then you transfer the cost out of finished goods into the cost of goods sold. This is the same type of cost of goods sold account you saw in the first course, your first accounting course. So we're going to debit cost of goods sold, credit finished goods inventory for the cost of the units that you sold. So a minute ago, we accumulated in the work in process account the materials, labor, and overhead. When you finish the job, transfer the cost for the finished job into finished goods inventory. And now the units that you sell, the cost of those units are transferred out of finished goods into cost of goods sold. And here's where all those production costs finally hit the income statement. So all these costs you've accumulated during production, materials, labor, and all those overhead costs, none of those touch the income statement until you finish them and then you sell them. And then they hit cost of goods sold. At that time, you'll have your your revenue that you recognize, and then you're going to have this expense, this cost of goods sold account that you recognize. Here's an example. Let's say, again, this corresponds to the numbers you had in your book, that you sold 750 of the 1,000 units that you produced during this period, that you finished. You sold 750. You had 1,000 that you did finish producing. The total cost was $158,000. And if you produced 1,000 units, your cost per unit is $158. If you sell those for $225,000, then the entry would be debit account receivable or debit cash if you collected cash immediately, and then credit sales for $225,000. That's the revenue you've earned. Then in the cost of goods sold, the $118,500 is found by taking the $158 per unit times the 750 units that you're selling. So you produced 1,000, but you only sold 750. So you only expense in the cost of goods sold the cost of the units that you sold. So again, debit cost of goods sold, credit finished goods inventory for the cost of the units that you sold. In the chapter, you notice that there are a couple of schedules that they covered. One is a new one, the schedule of cost of goods manufactured, and then that leads into the cost of goods sold schedule. In the schedule of cost of goods manufactured, we show the amount of materials, labor, and overhead we used, and then we can also adjust for some applied overhead. Well, this is in really the cost of goods sold areas. Let's skip that for a second. Here's what I want to show you. This is actually the solution to exercise 3.6 in the back of your chapter. So those are the numbers they use in the back of the chapter. This is an assignment that will be on Connect. You'll have to work the same one, but different numbers. Okay. So here's what the schedule of cost of goods manufactured looks like. They want to show how much in materials you used, but we go through these steps first. So start with your beginning raw materials inventory left over from last year. Add what you purchased this year. That shows you total raw materials available for your use. You could have used 125,000 into production, but we did not because we had ending inventory of 15,000. So this is total we had. This is what we did not use. That means after you subtract, the $110,000 is the amount that we used in production this year. So this is your direct materials used in production, $110,000. Direct labor, 70,000. Overhead applied, 90. Add materials, labor, overhead. Your total manufacturing cost will be the 270. Again, the total of your materials, labor, and overhead. Add to that what you did not complete last period, your beginning work in process inventory, and get just a subtotal here. Take away your ending work in process inventory, $5,000. The $5,000 represents the materials, labor, and overhead associated with the units that you started this period, but you did not finish. You're going to finish those next period. So we take away the $5,000. That means the cost of goods manufactured, the cost of the goods we completed this period, is equal to $275,000. It's very important to understand this. This is not your total production cost. That was up in here, $270. And then we even had some left over from last year. So $280,000 we have total production cost, including last year's production cost. But since we did not finish all the units, the materials, labor, and overhead that adds up to $5,000 of the unfinished units are pulled away, and the $275 represents the cost of the goods manufactured, or in other words, finished this period, $275. Okay, we're going to see this number again in the next slide. It's right here. First of all, add beginning finished goods inventory. That's what we did not sell in the last accounting period. Let's add the cost of goods manufactured. We got this from the previous slide in the other statement. Cost of goods available for sale. This is the amount that we're trying to sell this period. Did we sell all this? No, because we had ending finished goods inventory, $35,000 of product we did not sell. Hopefully we'll sell this next period. So the amount that we sold, $260, they call this unadjusted, $260, because here's where your over or under applied overhead we talked about in the last chapter comes into play. We use that to either increase or decrease our cost of goods sold this period, depending on whether we over or under applied the overhead. In this case, since we applied too much overhead into production, we have to take away the part of the over applied overhead. And so we're going to subtract from the $260 the $10,000. And so our adjusted cost of goods sold this period, $250,000. So again, the $10,000 is the amount of overhead that we applied too much, but that was okay because during the year, as we were using the predetermined overhead rate, that was based on an estimate, and we're never going to be 100% accurate. So whatever you need to do, if it's over applied, the amount over applied, you subtract. If we had under applied, we had not applied enough, you would add this number. So in this case, we over applied by 10,000, subtract it, so we're down to 250, which will be the cost of goods sold that we see in the income statement. So we'll see this number on the next slide. Here it is. Sales, again, just a made-up number from your chapter, 524. Cost of goods sold, there's the 250. Our gross margin or gross profit, 274. And then we take away the total of our selling administrative expenses to get net operating income. And of course, below net operating income, we would have those non-operating items, and then finally we would have net income, even after take away the income tax expense. So these three slides, go back up, starting here. This is the solution. So here's some check figures. Go back and test yourself. To exercise 3.6 in the back of your book. Here's the schedule of cost of goods manufactured, the schedule of cost of goods sold, and then here's the income statement, a partial income statement. Key concepts we just talked about, over or under applied. Again, we talked about this in the last chapter. You can read this definition. It's in your book. This is the under applied definition. Here's the over applied definition. And then this is showing you that if we have $30,000 of over applied overhead, then again, this doesn't follow with exercise 3.6. But if you had $30,000 of over applied overhead, you can see that you applied $680,000 to jobs during the year. We only incurred actual cost $650. So we over applied by $30,000. We need to bring this account to zero at the end of the year. So if it has a $30,000 credit balance, we've over applied. So we'll debit this account, manufacturing overhead, by $30,000. We'll credit cost of goods sold to reduce cost of goods sold by $30,000. So this is the entry you would use if you over applied the overhead. You would bring this account to zero, and you would reduce the cost of goods sold account. That's the end of the Chapter 3 material. It seemed like it's a little bit more detailed than the previous chapter. Please go back and read the chapter closely, follow the examples through, follow the numbers through, and make sure you understand why they're using certain numbers and certain accounts as you go through the chapter. So, study hard and good luck with the material.